This video is on Chapter 23, Relevant Costs for Managerial Decisions, and we will look at the alternate exercises for 23:1, 4, and 13. In this first one, we're going to look at make or buy analysis for this particular part. So right now, this company pays $7.30 to buy this part for one of the products it makes, but they're considering making the part. If they make the part, it will cost them $8.40 per unit for direct materials and $1 for direct labor per unit. They normally apply overhead at a predetermined overhead rate of 200% of direct labor cost, and incremental overhead, though, is 80% of direct labor cost. When we're looking at make or buy analysis, we're looking at incremental cost. That will include direct materials, direct labor, and incremental overhead. So here is the analysis. It will cost them $8.40 for materials, $1 for labor. Incremental overhead is 80% of direct labor, so 80% of $1. It will cost them $10.20 to make it. They can buy it for $7.30, so what should they do? They should buy the part. It will save them $2.90 per unit. In this exercise, we will look at scrap or rework. This happens when they produce a product that is not perfect and they need to rework it, or maybe just sell it as a product that they could not sell for full price. So it's a defective unit. They have 13,000 defective units, and they've already spent 110,000. This is considered a sunk cost. Sunk costs, as you'll recall from Chapter 23, are not relevant, so we will exclude the 110. The units can be sold right now as defective units for 60,000, or they can rework them at an additional cost of 90,000 and then sell them for 185,000. So what should they do? The revenue, if they sell them right now, is 60,000, no additional cost. If they rework them, they will earn 185,000, but it will cost them 90,000 to do that. So if they rework them, they can earn 95,000 versus if they scrap them, they can only earn 60,000. So they should rework them because they will earn an additional 35,000, which is called incremental income. Here we're looking at an alternate of exercise 23:13, and this is called a special offer. Here's their normal information per unit. The company receives a special offer for 10,000 units to be sold at $12 per unit. How much do they normally sell them for? $18. And this company wants them to sell them for only $12. So should they do that? Variable costs remain the same. So direct materials, direct labor, and variable overhead will remain the same. The special offer would require incremental fixed overhead of a total of 25,000, and fixed and general administrative cost incremental would be 9,000. So what should they do? I want to do an analysis here. So the revenue would be $12. This is a total for 10,000 units. 12 times 10,000 is 120. We list our variable cost, 3, 5, and 1. So right here we can see they're going to make a contribution margin of $3 because they're selling them for 12 and their cost is 9. So 12 minus 9 is 3. They will have a contribution margin. Now we need to subtract the incremental . overhead. 25,000 incremental for fixed and 9,000 incremental for general and administrative. They will not make money if they accept this special offer, because they're going to have a loss of $4,000, so they would not want to accept this offer. The last question on Chapter 23 is an Excel simulation on make or buy. You've already completed several Excel simulations, but you can go back to Chapter 15 if you would like a review of the Excel sim orientation. This concludes the video on the exercises for Chapter 23.